Hello once again, and welcome back to Really Hard Accounting. And in this lesson, we're going to tackle intercorporate transactions, because there's some transactions that happen between related or affiliated companies which really are like funny money when you think about it in the global context of a consolidation. So without further ado, let's dive in and see what Bob's up to next. So once again, we've got Parent Corporation, which is wholly owned by Bob. 3 years ago, Parent Corporation acquired 80% of the outstanding shares of GCO. The other 20% is a retained interest held by the shareholder from whom Bob bought his interest in GCO. GCO is a subsidiary of Parent Corporation because Parent Corporation controls GCO. Let's try and pictorially represent the consolidation process so that we can begin to have a common understanding of the highly technical terms that I'll use in this module, like the bubble. In the center of your screen, you see Parent Corporation and GCO. The arrows in this depiction reflect the flow of economic value, not ownership. For instance, both Parent Corporation and GCO contract with customers to deliver goods and services. Similarly, Parent Corporation and GCO both contract with suppliers and employees to purchase goods, services, and even possibly capital. Parent Corporation and potentially GCO may transact with its owners, Bob, or the non-controlling interest, as well to provide equity capital or to pay dividends. It's a simplistic representation, but you get the idea. Now, in the center of our screen, we have our legal entities, Parent Corporation, or PCO, and GCO. The red circle around these entities is intended to represent the consolidated Parent Corporation. I'm going to call this the bubble, just to coin a term to help you remember. Now, anytime this bubble transacts with customers, suppliers, employees, or owners that reside outside the bubble, we need to represent these transactions in aggregate. For example, if Parent Corporation buys inventory from a supplier and GCO buys the inventory from a supplier, the consolidated results reflect the purchases of both Parent Corporation and GCO. Let's call all the activity happening outside of the bubble and these third parties as happening in the consolidation zone. That is, any transactions that cross the thick red boundary. So far in this course, that's really been most of what we have been dealing with, aside from eliminating the intercorporate investment and dividend accounts. However, very often there is also activity between the legal entities within the bubble. There could also be activity between divisions within the same legal entity. Regardless, activity that happens within the bubble does not count for consolidation purposes. Why? Think of it like the funny money I mentioned at the outset. The reason is because selling and buying goods and services between entities that are jointly owned and controlled is like doing business with yourself. It's just not possible to recognize those transactions as having occurred for GAAP purposes. Note that your taxing authorities may say something different, so it's easy to get confused. Taxing authorities tax legal entities, not accounting entities. But the bottom line is that when transactions occur within the bubble and haven't yet permeated the bubble boundary, these must be eliminated. Let's refer to this area as the elimination zone. With that introduction, let's now look at the different types of transactions that happen in the elimination zone and learn how we need to make adjustments to our consolidation to eliminate this activity. There are two types of eliminations that we need to identify and adjust for. The first type we will look at are fairly straightforward. These eliminations have no impact on consolidated income. They merely need to be identified and offset so as to not overstate assets, liabilities, revenue, or expenses. The list presented on the left is fairly straightforward to identify. One company will report a receivable and the other should report an offsetting payable. One company will report a revenue, and the other will report an offsetting expense for the same amount. The practical challenge is to ensure that both entities have achieved a similar cutoff. The second type of elimination is conceptually the same, but mechanically a little more challenging to calculate. These arise where there are transactions between a parent and a subsidiary where the accounting is such that the consolidated income will change once they are identified and eliminated. This typically arises when we are dealing with inter-period timing differences on the recognition of income. For example, one company sells inventory to the other and recognizes the sale, and the purchasing entity still holds the inventory at the reporting date. Because the inventory has yet to leave the bubble, that is, the consolidated entity has yet to sell the inventory to an unrelated third party, the gross profit cannot be recognized under GAAP. These sorts of adjustments typically impact one or more reporting periods and as such require continuity schedules to track the elimination and the eventual recognition. Let's start with the simpler types of elimination. Let's assume that Parent Corporation rents space from GCO, as well as provides short-term funding. The first type of elimination would look like this on our schematic. The red arrow going between Parent Corporation and GCO would represent the flow and payment for goods and services. Notice that nothing is leaving the bubble. There's nothing to consolidate and everything must be eliminated. Let's see how our consolidation worksheet accounts for these transactions. The consolidation worksheet presented here picks up from where we left off in our last lesson. However, we now incorporate the elimination of the intercorporate activity denoted in the red font. On the consolidated balance sheet, you can see the amounts that would be eliminated from the receivables and payables. Not eliminating these intercompany accounts would result in an overstatement of receivables and payables and could impact ratio analysis. On the consolidated income statement, the rental income reported in GCO and the rent expense recorded in Parent Corporation need to be eliminated to avoid overstating revenues and expenses. These types of transactions are fairly obvious and intuitive to understand. They largely represent the funny money that is created between two entities that are consolidated. What gets more difficult to account for is when there's timing differences on the recognition of income. Let's look at a variety of these sorts of transactions next. To isolate the moving parts, let's just follow the stream of one economic transaction. In coming scenarios, we'll use the same transaction to explore the various potential ways intercorporate transactions might arise. In this case, let's assume in year one that Parent Corporation purchases inventory from a supplier for $490. Parent Corporation then turns around and sells the inventory to GCO for $700, recording a gross profit on the sale of $210. In the same year, GCO sells the inventory to a third-party customer for $1,000. This is referred to as a downstream transaction because Parent Corporation is selling the goods downstream to the subsidiary of GCO. If the subsidiary was wholly owned, the distinction would not have much relevance. But because GCO is an 80% subsidiary, identifying the direction of the transaction is important. For clarity purposes, let's call this downstream transaction as a P to S transaction. In other words, a parent to subsidiary transaction. Let's track the relevant accounts to consolidate these transactions. This table summarizes the consolidation. Notice how the $700 purchase and sale is eliminated because the inventory was bought and sold in the same period. This is again one of those simple type eliminations like the rent example we just saw. Let's look at the Parent Corporation consolidated numbers and ensure that these numbers make sense. First, let's look at income taxes. The $204 works out to be an effective tax rate of 40% of earnings before tax, which makes sense. But what about the gross profit percentage of 51%? Does that make sense? Gross profit, on both the initial sale by parent corporation to GCO was 30%, as well as the sale from GCO to the third-party customer. So how did gross profit increase on the consolidated income statement? Well, the reality is that GCO added additional value to the inventory and was able to sell the inventory for a higher price than it paid to parent corporation. And as a result, the gross profits are additive on a consolidated basis, which results in a gross profit percentage of 51%. Keep this gross profit percentage in mind as we explore the other related scenarios using this information. Scenario B is the same as Scenario A, except notice that GCO is still holding $200 of inventory at the reporting date. Let's track the relevant accounts to consolidate these transactions. Egads, where did these numbers come from? Well, parent corporation column hasn't changed from Scenario A. Let's start at the bottom of the GCO column and work our way up. We know that GCO still held $200 of inventory at the period end reporting date, which means that $500 represents the cost of sales. We know that GCO sells inventory to earn a 30% gross profit, so we were able to determine that GCO's non-consolidated sales were $714 and the gross profit was $214. Income taxes at the 40% rate would be attributed to these levels of sales of $86. The eliminations work similar to Scenario A in some respects in that the $700 of sales and purchases between PCO and GCO must be eliminated. The rest gets a little bit trickier. Of the $200 of inventory held by GCO, parent corporation recognized a 30% gross profit margin, or $60. As this inventory has not yet left the bubble, we need to adjust the inventory carrying value for the profit in ending inventory. The offsetting $60 credit is to the cost of sales, which reduces gross profit by $60. That is sometimes hard for learners to comprehend, but keep in mind how the cost of sales is calculated. Opening inventory plus purchases less ending inventory. As ending inventory is reduced by $60, cost of sales is necessarily increased by $60 by that equation. In many countries, the legal entities themselves are taxable. Thus, this $60 would be taxed as profit in parent corporation as the transaction between PCO and GCO is taxable. However, for consolidated GAAP purposes, we have deferred recognition of the profit until the $200 in inventory held by GCO is sold outside the bubble. As a result, we must also defer recognition of the income tax expense as well to align the recognition. The deferral of tax recognition reduces our income tax expense as we park the debit as a deferred tax asset on the balance sheet. To validate our adjustments, it is always advisable to review the consolidated results to ensure they make sense. Our consolidated sales of $714 feels right, as this reflects only the sales that permeated outside of the bubble. Our gross profit percentage of 51% is consistent with what we saw in Scenario A. The effective income tax rate on a consolidated basis is 40%, the same as the statutory rate. The inventory balance makes sense, as this balance now reflects PCO's original cost for this inventory. Thus, our consolidation adjustment appears appropriate. Let's move on to year 2. The first two columns carry forward the balances on the statement of financial position. The third column shows GCO selling the remainder of the inventory and reporting the sales of $286 with the gross profit of $86. When it comes to preparing the eliminations, the previously unreported profit of parent corporation is now realized with the ultimate sale of the remaining inventory outside the bubble. So the entries to realize this profit reverse the entries made in year 1 to defer it. Sales to outside third parties of $286 makes sense, and when added with the $712 in year 1 totaled the $1,000 in sales we saw in Scenario A. The gross profit of $146 equates to the 51% gross profit consistent with our previous analysis. The effective tax rate looks right. So at this point it appears that our consolidated financial statements work. And if we were to add the year 1 financial statements to the year 2 financial statements, we would indeed determine that the results mirror the results we learned in scenario A. Now let's look at the same transaction as we did in scenario B, only this time the subsidiary G-Co buys the inventory initially from the external supplier and then resells it to parent corporation, who eventually sells it to the external third-party customer. Keep in mind that G-Co is an 80% owned subsidiary, which means that it will be necessary to consider the non-controlling interest. We will refer to this type of transaction as an upstream transaction, or for short, an S to P transaction, which stands for subsidiary to parent. Let's prepare a worksheet to show the consolidation. Once again, the $700 intercorporate purchase of sales must be eliminated. However, because this is an S to P transaction, a portion of the profits eliminated actually belong to the non-controlling interest and must be allocated accordingly, $25 in this case. Keep in mind that the accounting and recognition for the non-controlling interest generally follows that of the parent. This is the same transaction as scenario C. Only $200 of inventory remains on hand in P-Co, which was purchased from G-Co. As we saw in scenario B, P-Co realized sales of $714 in year 1, with the $286 balance being realized in year 2. In year 1, we still have all of the same entries as we did in scenario C to eliminate the sales and purchases. However, we now have inventory on parent company's books of $200, which includes $60 of gross profit that was earned by G-Co. As the inventory has not yet permeated the bubble, the gross profit recognized by G-Co must be eliminated on the consolidated financial statements for accounting purposes. The offsetting debit is to cost of sales. To ensure that the taxes are recognized as income is earned, there is a portion of the income taxes paid that is deferred along with the gross profit. This amounts to $24 and is presented as an income tax recovery on the income statement and a deferred asset on the statement of financial position. Finally, in an upstream S to P transaction, non-controlling interest must be taken into consideration. Non-controlling interest is treated the same way as the controlling interest in terms of its income allocation. Thus, if the controlling interest has to wait to recognize gross profit and inventory held, then so does the non-controlling interest. The calculation would be the pre-consolidated G-Co net income, which is the $210 minus $86, which is $126, less the deferred net income, which is essentially the $60 minus the $24. Both multiplied by the 20% non-controlling interest, which is $18. In other words, $7 gets deferred until parent company ultimately sells the inventory to a third party outside the bubble. Both our gross profit percentage, 51%, and our effective tax rate of 40% are as expected, validating our consolidation entries. In year 2, parent corporation does sell the remaining inventory to a third party for $286 and records the profits accordingly. The elimination entries for year 2 will reverse the adjustments made in year 1. The $60 in gross profit legally earned by G-Co that got deferred for accounting reasons can now be recognized. This will trigger the reversal of the tax deferral as well. And finally, because this is an S to P transaction, the non-controlling interest will also get to pick up its portion of the income which was deferred from year 1. By analytically reviewing our results, our gross profit and tax rates are as expected, and the non-controlling interest on the balance sheet reflects the full $25 that we saw in scenario C. A similar sort of phenomena will arise with land sales and depreciable asset sales between affiliated companies. But we're going to save that for another lesson. So until then, don't stop to get to the top. When you get to the top, don't stop.